Good morning all, and welcome to the Economist Masterclass hosted by the Banking and Payments Federation Ireland. I'm delighted to have 5th and 6th year students today from over 100 schools from across 22 counties joining us online. I'm Ali Ugur, Chief Economist with the Bpfi. Just a bit of a background in terms of our what is now an annual masterclass. It's part of the European Money Week as well as the Global Money Week, which starts next Monday on 18th of March. There's going to be a week of events for young people across Europe and the globe, mainly focusing on financial education and raising awareness about money and personal finances. Another reminder is in relation to the European Money Quiz. We are hosting the Irish finals of the European Money Quiz next Thursday, 21st of March at 12 noon. So if there are any teachers with the junior cert cycle students that haven't registered, you still have time. The winning team will win a trip to Brussels to represent Ireland in the European finals of the quiz on the 18th and 19th of April. So it's a good opportunity to be able to visit Brussels. And a recording of today's masterclass will be available on YouTube in the coming days, and an email with the link will be shared with teachers who are registered for this event. So without ado, I'd like to introduce our guest speakers today, two senior economists, Michael Crowley and from Bank of Ireland, and John Fahey from AIB. Michael, I'll hand it over to you in relation to your presentation, if you're ready, in the global economic developments.
Yeah, thank you, Ali, and good morning, everyone. You're welcome to the masterclass. As Ali said, my name is Michael Crowley, and I am an economist with Bank of Ireland. And when I spoke to students this time last year, the central banks in the main economies and indeed around the world were raising interest rates in response to what was really an unprecedented surge in inflation to levels that we hadn't seen since, well, in decades, really, probably since the 1970s. And as you can see in this next, in the first slide, actually, central banks continued to raise interest rates beyond March through the third quarter of last year, stopping around then, but keeping interest rates at very high levels since then. And as you can see, interest rates in the US, as set by the Fed, in the Euro area as set by the ECB, and in the UK as set by the Bank of England, are at levels that we haven't seen since the mid-2000s. And the reason why central banks were raising interest rates was, as I say, in response to that increase in inflation. And the idea, as far as the central banks are concerned, is that by increasing interest rates and increasing borrowing costs in the economy, it dampens demand in the economy, it slows economic growth in economies. That in turn leads to a dampening or an easing of price pressures, and that in turn leads to a slowdown and a fall in inflation. So if you look at the next slide, that increase in interest rates by those major central banks has led, as you can see, to a slowdown in GDP growth. Just going back a little bit, GDP in the major economies fell very sharply in 2020 because of the pandemic, which led to the closure effectively of economies. As economies reopened in 2022, GDP rebounded very strongly. So there was always going to be a slowdown in GDP growth from those elevated levels that you can see in the chart there. But certainly the increase in interest rates, if you like, exacerbated that slowdown and did reduce growth in the economies. Indeed, in the Euro area and UK economies, as you can see, GDP did not increase at all in 2023, so those economies didn't grow. The US economy has been pretty resilient and kind of surprisingly resilient in the face of higher interest rates. Growth did slow in 2022, but rebounded a bit in 2023. But overall, as you can see, the picture there is one of lower growth overall. And then when you look at inflation in the next slide, you can see that inflation has come down very, very sharply. Actually, it has come down almost as sharply as it went up. Now, I think when you look at the detail behind that fall in inflation, central banks cannot take the credit for that fall in inflation, certainly not for all of the fall in inflation, and indeed, nor would they take all the credit for the fall in inflation. But nevertheless, inflation now in the main economies is back in the Euro area and the US to, between 2 and 3%, a little bit higher in the case of the UK at around 4%. But even in the case of the UK, over the next few months, we are likely to see a further fall in inflation there, probably down to 2% and even perhaps below. It is interesting also when you consider the scale of the increase in inflation and the level to which it rose, that consumers' inflation expectations, and you can see this on the next slide. Just moving on there if you want to, please. Consumers' expectations of inflation over the medium to long term, so what inflation will be over the medium to long term, has remained very stable, between 2 and 3% in the case of the euro area and the US, as measured by the ECB and by the Fed in the US. And that is, if you like, noteworthy, given that actual inflation went up a lot. And I suppose this is where the central banks would take some credit, because what central banks really fear is that if inflation goes up, and particularly if it goes up to the high levels we've seen recently, that consumers will expect inflation to remain high, if you like, permanently. And it almost becomes self-fulfilling, so that higher expected inflation leads to permanently high actual inflation. And so what the central banks have done by raising interest rates is, I suppose, demonstrating their resolve not to let high inflation become permanent, that it will do whatever it takes to bring inflation back down again. And that has, I think it's fair to say, helped to keep inflation expectations in check. And as I said, inflation expectations running at around 2 to 3% in terms of consumers' assessment of where inflation would be over the medium to long term. But if you look at the reasons why actual inflation has come down, and you can see these in the next few slides, it really is, to a large extent, a reversal of the forces that drove up inflation in the first place. So if you look at things like energy price inflation as measured in the Consumer Price Index, energy price inflation went up very sharply in 2021 and particularly in 2022. And that followed an increase in global oil prices and European wholesale gas prices, particularly gas prices, following the outbreak of the war in Ukraine. Russia is an important exporter of oil and gas. There was concerns about the supply of oil and gas when the war broke out. That led to much higher, as I say, oil and particularly gas prices. And those higher prices for oil and gas fed directly into higher energy price inflation. Over the course of the last year, we've seen energy prices at the wholesale and global level come right down again, particularly again, gas prices have fallen sharply, and that has fed through directly into lower energy price inflation. And if you look at energy as a share of the overall consumer price index, it can be up to anything like 10%. So when energy price inflation was running at 40, 50, 60%, that was adding 4 or 5 or 6 percentage points to overall inflation. Now energy price inflation is negative. So energy prices now are lower than they were this time last year. So you have negative inflation, and that's making a negative contribution to overall inflation. Something very similar happened in the case of food price inflation at the consumer level, which went up very, very sharply. Again, that was partly related to events in the Ukraine. The Ukraine was an important food exporter. We did see a fairly significant increase in food commodity prices. That in turn eventually fed through into higher food price inflation at the consumer level. But again, over the last years or so, food commodity prices have fallen quite sharply. They're lower now than they were this year, and that is and has fed through into lower food price inflation, as I say, at the consumer level. And again, given the weight of food in the overall consumer price index, which can be between 15 and 20%, then lower food price inflation is increasingly making a smaller contribution to overall inflation. So there are two important factors, if you like, behind the recent fall in overall inflation at the consumer level in these economies, the US, Euro area, and UK. If you look then beyond energy and food, and you can see this on the next slide. So-called core inflation or underlying inflation, which is what central banks look at very closely. underlying or core inflation excludes food and energy prices. And underlying inflation tends to be less volatile than you see in the case of food price inflation or energy price inflation. But in the case of core inflation, that too has come down over the last while. It's higher than overall inflation, but still coming down. So between 3 and 4% in the euro area in the US, a little bit higher once again in the UK at around 5%, but it is coming down. And again, we can look at the reasons why that is happening, which you can see on the next slide. So again, considering what contributed, I suppose, to the increase in underlying and core inflation in the first place, well, one was that we saw, again, a really unusual and almost unprecedented increase in goods inflation. And what happened there really was that at the outset of the pandemic and during the pandemic, as economies were closed and people could not go out and spend in restaurants or in hotels or going to the cinema or going to sports events, there was a big increase in demand for goods, a lot of online purchasing. So that increase in demand for goods would have put upward pressure on goods prices. But along with that, there was serious supply disruption, global supply disruption and disruption to supply chains because of the pandemic. So you had that increase in demand for goods alongside restrictions on supply or supply shortages for goods. And remember, goods are kind of internationally traded and imported into a lot of economies. And that imbalance between demand and supply led to, again, an unprecedented surge in goods inflation, which usually is either negative or close to 0%, but rose, as you can see in some cases there, to over 12%. But as the pandemic faded, as economies reopened again, as people could go out and spend in the restaurants and the hotels and all of that, the demand for goods eased off. At the same time, the supply chain disruptions came to an end effectively. And that better balance between demand and supply has led, again, to a notable fall in goods inflation in the main economies. And that is, again, contributing to the decline in overall inflation. The other component of underlying or core inflation is services inflation. And services inflation includes things like, as I said, the hotels, eating out in restaurants, going to the cinema, going to sporting events, lots of those kind of personal services, you might call them. And services inflation is much more determined by conditions within economies, so domestic conditions, as they are called. And I suppose just as the closing down of economies boosted demand for goods, when economies reopened, people were in a rush to go out and spend again, particularly on their favorite things like eating out or whatever it might be. And so we saw a big increased demand for services, a big increase in spending on services, and that certainly contributed to an increase in services inflation. The increase in demand for services as the economies reopened after the pandemic also occurred in the context of, very tight labour markets, very low unemployment, lots of labour shortages. Those labour shortages contributed to an increase in wage inflation, which was also going up because workers were trying to compensate for the increase in inflation by receiving and demanding higher wages. Wages are a very important component of overall costs for companies working in the in the services sector. And therefore, as wage growth went up in the services sector, that was passed on in the form of higher prices for services. So you can see again a notable increase in services price inflation during and after, particularly after the pandemic. There has been some slowdown in services inflation over the last while, certainly not as pronounced as for goods inflation or for overall inflation, but nevertheless coming down. And I suppose it's the services inflation bit that central banks think that they can influence the most. So by increasing interest rates And as I said earlier, slowing down demand, also slowing down demand for labour, which you can see in the economies that we're looking at here, the US, Euro area and UK. Even though unemployment rates remain very low in those economies, the number of job vacancies in those economies, which had been very, very high just after the pandemic, have started to come down quite a bit. And wage growth has started to come down as well. And it is expected that slower wage growth will in turn feed through into lower services inflation and contribute to a further fall in overall inflation back towards the kind of levels that the central banks like to see, which is in and around 2%, which for many central banks is their target measure of inflation. And I suppose, given forecasts for economic growth this year and even into next year, it is expected that growth will remain relatively weak. So I'll show you this in the next slide. These are the latest forecasts for economic growth from the OECD for the economies we're looking at here and for the global economy. As you can see, in the case of the US, as I mentioned earlier, growth in 2023 was stronger than many people expected, but nevertheless, the OECD expects growth to slow down in 24 and into 25 to rates which would be below what's kind of normal, if you like, for the US economy, which is slightly above 2%. Likewise, in the euro area, growth this year is expected to be quite weak again. GDP growth at 0.6%, much the same as last year, expected to pick up next year to around 1.3%. Part of the reason for that is it is expected that lower inflation will boost household incomes in real terms and lead to some increase in consumer spending and therefore stronger overall GDP growth. But nevertheless, that growth of 1.3% is slightly lower than what might be normal in the euro area. And very similarly in the UK, you can see very weak growth last year, growth expected to remain weak enough this year. I'll be picking up a bit next year for the same reasons as I mentioned earlier. In the case of the euro area, lower inflation helping to boost incomes in real terms and to boost consumer spending. But again, overall GDP growth relatively weak compared to what might normally be the case. And in that context, therefore, of weak-ish or economic growth or weaker growth than might normally be the case, then it is expected that inflation in the main economies will continue to fall and head back down towards that 2% target. And you can see that in the case of the forecast from the OECD for inflation, which are on the next slide. So again, inflation in the US expected to fall this year from last year, and in 2025 to be back at around 2%. Again, in the euro area, inflation after that high reading in 2023 over 5%, almost 5.5%. Inflation expected to average 2.6% this year and to fall back very close to the 2% target, 2.2% next year. And similarly, in the case of the UK, inflation expected to fall this year and again to fall next year down to below 2.5%, not far from 2%. So we have really, in a relatively short period of time, almost come full circle in terms of inflation. And it has been, for many, a surprisingly rapid and quick fall in inflation, given the fears that were around, for example, this time last year when I did the same presentation to students, that inflation might remain, high for a long period of time. I think most people, most commentators, most economists, the public even perhaps, surprised by the extent to which inflation has fallen and how rapidly it has fallen. And the implication of that then for interest rates is that, and you can see this on the next slide.
1 minute, please, Michael.
Yes, that the market now expects the central banks during the course of this year to start lowering interest rates again. So we could be coming to the point where we're full circle again on interest rates. So after the big increase in interest rates we saw during the course of 2022 and 2023, that over the course of 24 and 25, the central banks are expected to lower interest rates. And you can see there for the US, for the euro area, for the UK, Interest rates expected to come down to, between 2 and 3%, a little above 3%, a lot lower than where they are now, although by the same token, interest rates expected to kind of settle at higher levels than they did before the pandemic, when interest rates were at 0%, and in some cases negative in the case of the euro area. And that, in fact, was when inflation was extremely low, actually too low for the central banks liking, below 2%, and they were trying to get inflation up again by keeping interest rates at 0 or lower. So, yeah, as I say, coming full circle on interest rates again, it looks like now, with the market expecting interest rates to fall over the course of this year and into next year as inflation comes down. So that concludes my piece, as Ali warned me there. So I think it's over to John, I think.
Thank you, Michael. It's been an interesting last 2 years, I suppose, for the students listening to us. They got used to low interest rates, low inflation rates, but the last couple of years has been interesting. All right, interesting experience. And I'll come back to you with questions later on, Michael, if that's okay. Yeah. John, I'll hand over to you now, please.
Okay, perfect. Thanks, Ali. Good morning, everyone. So as Michael was saying there, the global backdrop was one of slower growth. So from an Irish economy viewpoint, given that we're such an open economy, it's no surprise that growth in the Irish economy slowed as well last year, because our 3 key trading partners, the US, the Eurozone and the UK, have generally seen slower economic activity. But when you're looking at the Irish economy, and in school at the moment, I suppose you're learning about what the economy is made up of in terms of GDP equals consumption plus investment plus government spending, and net trade, which is your exports minus your imports. Well, in the case of the Irish economy, that export aspect is exceptionally big. It's actually bigger than GDP. So when you look at the size of exports overall compared to the size of the economy, exports are about 130% of GDP. So exports, and they tend to be dominated by multinational activity and tend to be concentrated in the pharmaceutical sector as well as the information communication technology sector. So a couple of firms can have a big impact on our export number, and in turn then that can have a big impact on our GDP number. And because of the pharma sector actually did very well during COVID, because of what was involved in that pandemic and the demand for their goods. So that saw our goods exports surge. But obviously last year we got back to more normal times, thankfully. But as a result of that, the demand for those type of goods started to fall. So, where exports of goods increased in the region of 20% in 21 and 22, they fell by 12% in 2023. So as a result of that, our GDP overall fell by over 3%. Now that was on the back of very strong growth of 9.4% the previous year and over 15% in 2021. But what we always say is when you're trying to get a handle in terms of what's happening in the Irish economy, you have to ignore GDP. It's not a good measure of underlying activity in the Irish economy, because a lot of the activity is multinational activity, and a lot of that has nothing to do with what's happening elsewhere. So if you look at the next graph there, or next slide, you can see just visually what that means in terms of aspects or sectors that are foreign owned, foreign direct investment related, or domestic growth. So you can see there visually when you look at 2022 and 2021, that pink purple bar, very strong growth in that sector, whereas the domestic economy struggled much more. Whereas last year, you see that output related to foreign owned sector, multinational sector, contracted by around 7%. So that visually is a good way of looking at just the different dual economy aspect of the Irish economy. And export of goods fell. Export of services held up pretty well, but really a truer measure of what's happening is what the CSO produce, called modified final domestic demand, and that strips out the distortions caused by multinational activity. It removes exports obviously from the equation as domestic demand, but also strips out some distortions within the investment component. But even when you look at that shows that growth slowed as well last year. So for the full year of 2023, domestic demand was in around just 0.5%. So even if you ignore what's happening in GDP, and we can see signs that the domestic economy did slow, and that's no surprise against the backdrop where interest rates have been increasing, and that's impacted obviously higher inflation. The amount of money you can purchase in terms of your real income, real wages, real disposable income has been impacted by that, and as a result, you see their consumer spending has also fallen back, but in growth terms, it still remains fairly healthy at just above 3%. So not as strong as it was post the pandemic, but that was an artificial aspect too, because Michael referenced there shutdowns, sudden release of pent-up demand, sudden release of buying. So we're back to a more normalized rate in terms of where consumer spending should be. But then if we look at some other aspects of the economy, so just on the next slide there, we always look at what's happening in the labour market. And if you look at the unemployment rate there, very exceptionally low levels, in around 4.5%. So for all intents and purposes, the economy is in full employment. If you talk to businesses right down the breadth of the country, they talk about difficulty and issues around labour shortages in finding staff. And if you look at what's been driving that on the next graph there at the top, just look at underlying employment growth in terms of public and private sector. Obviously, public sector growth has tended, the rate of growth has slowed substantially there, but private sector employment and SMEs, what we call them, small, medium type enterprises, are the key employers in the economy. They employ well over 2/3 of the workforce, and they tend to be more domestically orientated in terms of their customer base. And last year we saw employment growth continue in a range of 3 to 4%. So very strong employment. So the labour market tells us that the economy is still in a good position. And then we also look at other indicators like PMIs, and these are called Purchasing Manager Indices. These are monthly surveys, so they're higher frequency than your GDP or your domestic demand data, which only come out quarterly and tend to come out towards the end of the following quarter. So we look at high frequency indicators like the PMIs, and the way they work is anything above 50 signifies the sector's in expansion. So you can see there both the manufacturing and services sector are in expansion, but you can see that the manufacturing sector has struggled because that tends to be more export orientated and more sensitive to global demand. And Michael referenced there, the strong demand in services across a lot of domestic economies, and that's reflected in the monthly PMI data. And then if we just look at where Irish inflation is relative to the Eurozone and the UK, and you can see broadly similar trend. If we just go back to that slide there for a sec, broadly similar trend in terms of where our inflation rate is versus the Eurozone and the UK. And that's important because obviously we don't want our inflation to be out of sync or higher than the Eurozone or the UK, because they're some of our key trading partners, and you want to maintain competitiveness. So our broadly inflation rate is moving in line with the inflation rates there in terms of being on a sustained downward trajectory. Then moving on, another key aspect when you're talking about the economy is obviously what's happening in the housing market. And you can see there in the chart in the top right that, when you look at the trajectory of house prices, the red line there is just your year-on-year rate. So it's house prices in 1 month compared to the same month a year ago. And your blue bars are month on month, so 1 month compared to the previous month. So for the first half of last year, we actually saw prices fall. But as we moved through the year on a month-on-month basis, that blue bar got back up above zero and prices started to pick up again. But generally speaking, the trend overall from your annual rate of house price growth is of much slower growth rate. We're at double-digit levels back in late 2021 into early 2022. And since then, the rate of increase in house prices has started to slow. It's more lower single digits. And one thing that's helped there has obviously been the increase in supply. So your Irish housing activity chart there, what we look at there is both completions, which is basically new supply, and commencements, which are housing starts. And housing starts tend to lead completions by 12 to 18 months. So every residential unit gets registered that's about to be commenced. And then over time, obviously, that becomes new supply when it gets built and fitted out. So you can see the supply picture has improved, and that's helped to put some of the upward pressure on prices to ease some of that. But we're still in a situation where the housing market is still defined by a supply shortfall. At a minimum, we need to build 30 to 35,000 units per annum. And only in the last 2 years have we got towards or just above that 30,000. So in the last couple of years, there's been a lot of pent-up demand building. So not only do we need to build at least 30, 35 units per annum, 1,000 units per annum, but we need to build more than that to meet the pent-up demand. So because of that, you're still seeing prices tending to move upwards because of the supply backdrop, where there just isn't enough supply coming on stream yet. And it's probably likely to be 2 to 3 more years before that situation and the market starts to become more closely in equilibrium, where supply and demand are more closely aligned. So that's the housing market backdrop. One important differentiation this time out to when the economy was dealing with the aftermath of the great financial crisis is that the economy is in a completely different debt position. So just moving ahead to the next slide there, Fiona, thanks. So when we were dealing with the aftermath of the Great Recession, the Great Financial Crisis, the big issue the economy had was there was a big debt overhang. There was a lot of debt, both in terms of the private sector and from a government sector perspective. And over the last 10 to 15 years, roughly, households and businesses have repaired their balance sheets. So they're carrying much lower levels of debt, or they're finding it easier to service the debt that they have. Now, you can see there in terms of the savings ratio, that obviously peaked during COVID because people just couldn't spend money even if they wanted to. So some of it was enforced, some of it was cautionary. And the savings rate has started to normalise now, and it's closer to its medium-term average in around 9 to 11%. But crucially, the build-up of savings that resulted from that spike in the savings rate is still there. So whilst the flow has slowed, the stock of savings is still very high. And at the same time, in terms of household debt ratios, are much lower compared to where they were in the aftermath of the great financial crisis. Similarly, the private sector overall, much lower levels of debt, and also in terms of the government budget is back in surplus now, and over the next couple of years the government expects to continue to add to its surplus. So that's important because from a consumer perspective, it means that consumers can continue to spend money. They're not paying down excessive levels of debt. And from a government perspective, it means the government can continue to increase its spending in year-on-year terms into the economy. It doesn't have to do fiscal retrenchment policy. It can continue to implement a fiscal expansionary policy. So that's all positive from the economic outlook. So just moving ahead then to the final slide on that outlook. In terms of where we are. So, as Michael said there, the global backdrop is one of more subdued or sub-standard growth for the global economy and some of the key advanced economies. So because of that, obviously, the Irish economy is on a much slower growth trajectory now. But there are a number of positives going. We've still seen continued large foreign direct inflows into the economy. So that will boost investment, exports and employment over the next number of years. Labour force growth has been very strong. The labour market remains very strong. And I referenced there the fact that fiscal policy will also continue to add to growth. And that combined with, high levels of household savings is all supportive of, the different aspects that can generate or determine and drive your underlying growth in the economy. So if you take an independent forecast, the Central Bank of Ireland think that GDP will average 3.5% over the next 3 years. And that we would share that view that it would be somewhere in the region of 3 to 3.5%. From a GDP perspective. And in terms of the domestic economy, growth probably in a region of 2 to 3%. And then just to finish up with the last few points there, obviously just, we mentioned there, the slower growth backdrop. So there are some risks and challenges, obviously, the economy has to deal with. I mentioned at the outset, heavy concentration within FDI, within a certain number of sectors, a certain number of firms. So that always makes us vulnerable to potential changes there. Also, the majority of Ireland's energy is imported. So over time, if we can move to more renewable domestic source of energy, that will help to reduce that reliance. We have capacity constraints in the economy. So this will impede the level of growth we can get, obviously housing, but also labour shortages, general infrastructure, and that can impact competitiveness. And then over the longer term, the economy is aging. Our population dynamics do show over the next 20 to 30 years a more aged population, a lower labour force size, a lower working force. And then you bring into that too the sustainability and the green agenda, the challenges around that, but also the opportunities. And then finally, just that technical innovation. Really in the last 12 months, artificial intelligence has come front and centre of a lot of public discourse. It's still very early days yet, but over the next 5 to 10 years, we see, what impact that has on different sectors and how the Irish economy can benefit from that. So I'm just going to finish up there. Hand back to you, Ali.
Thank you very much, John. So we got some interesting questions from some of our students. So I'll start with it. Michael, I might ask you the question about the domestic economy, given that you've covered the global economy. In terms of the housing, John talked about the housing output, sort of the expected increase in housing output. Michael, do you see any downside risks in relation to that, achieving that targets in terms of the potential labour shortages, skill shortages? Do you have views on that?
Yeah, I think there have been concerns expressed there about labour shortages in construction, and whether we'd have the workers that are needed to build the houses that we need. I suppose what's interesting at the moment is that we have seen some weakness in the commercial property sector, and I think that is potentially freeing up some labour that might be available to work in the housing sector and to contribute to the building of the housing units that are needed. But they certainly are needed, and supply is the major issue in terms of the housing market. And last year in 2023, surprisingly, I think housing output came in stronger than people had thought. So that was a positive outturn, and I think, looking at the forecasts that are out there from, as John mentioned, the central bank, they have put out forecasts today for housing output, and they see housing output increasing towards, 35, 36, 37,000 units per year over the next 2 to 3 years. I think that will be a welcome development and will help to ease, I suppose, price pressures in the housing market and bring the market into better balance. So, yeah, I think there are always risks out there in relation to achieving these targets, but I think the current confluence of events, with some weakness in the commercial property sector, in the construction, in the commercial property sector, and then freeing up resources to work in the residential sector, I think that could be good timing in a way, and will help as I say, increase the supply of housing that we need.
Thank you, Michael. This was a question from Loretta Secondary School in Wicklow, and another one, John. I might ask you on the very popular topic on housing. Do you think that the government interventions helped or worsened the situation in your view?
Yeah, well,
in relation to housing.
Yeah, so in terms of that housing for all strategy, obviously it's a positive when all key stakeholders are moving in the same direction in terms of achieving increased housing supply. So it's a positive when government policy is focused on that. And no matter what government is in power over the next couple of years, housing will still remain very much front and center of any key government policies, because it's obviously vital for the electorate, but it's also vital for the economy because of those capacity constraints. But it is the private sector that will build those houses. So it's positive when the government and policy is focused on that. But I suppose there's other areas where further progress can be made. Developers, builders will tell you, and key stakeholders, that the planning permission process can still, result in a lot of delays. And the focus now is to get more housing on stream. So there's probably further initiatives that can be done. But in terms of that housing for all strategy, the government policy around that, has helped to focus attention on the supply side, and then the private sector has started to come through in terms of delivering more houses, both in terms of social and obviously houses available for private sale.
Thanks, John. Another question from Glensdale Abbey in Limerick. Michael, I might want this question to you at first. I suppose people still remember the last recession that we went through in Ireland and globally, as well as part of a global recession. Do you see any downside risks to both the banking or the housing sectors in the current economic environment? Are we in a similar situation, or are we totally different?
I think we're probably in a different situation. I think when it comes to the banking sector, certainly, we did have a banking crisis back at the end of the 2000s, which led to a very sharp downturn in the Irish economy. But I think a couple of the charts that John showed there in his presentation would leave one relatively reassured that we won't have a kind of banking stroke housing crash, because if you go back to that banking stroke housing crash, it was related to very strong growth in credit, very strong growth in borrowing and lending in the economy for house purchase. Households have deleveraged a lot. They have reduced their debt levels quite significantly, as John showed in his chart. Credit growth has been relatively weak over the last while, albeit picking up a bit. And what we see happening to house prices at the moment, back again during the boom period, house prices were rising very rapidly because of very strong growth in demand due to very strong growth in credit. the kind of pressure on prices and house prices that we see at the moment are a reflection of the imbalance between demand and supply in the housing market. And as John alluded to there, there are measures being taken to improve housing output, to improve housing supply. Housing supply is going up, and therefore that will help to, as I say, bring the market back into better balance overall. So again, one can never say never, and I've been working in this area a long time, and there are always shocks that occur and always things that happen and catch you off guard. But certainly in terms of the banking stroke housing sector, the circumstances today are different from the circumstances, vastly different from the circumstances that led to the banking stroke housing crisis back in the 2000s.
Thank you, Michael. John, in your presentation, you refer to the role of exports and the exports by multinationals in the Irish economy. And this is a question from Crescent College and Comprehensive in Limerick. To what extent is increased immigration contributing to the Irish economy, if you take in the context of multinationals and the role of the multinationals in the significant exports from Ireland?
Yeah, well, obviously, from an economy point of view, if you look at the labour market and labour force growth, there is skills shortages, especially in the science ICT sector. So continued inward migration is needed to meet some of those skills shortages, but also just the general labour shortages that are in the economy. So we've seen strong labour force growth over the last number of years, driven by increased, first of all, female participation in the labour force, but also increased inward migration. So from that side, we need that to grow on a long-term basis. So it's been a positive on that front, and it's likely to need to continue given where the unemployment rate is at the moment. And a raft of different surveys from firms and small and medium enterprises continue to emphasize labour shortages and skills shortages. So we need that to come from external sources. So continued net inward migration is a positive from that viewpoint, and it will need to continue.
Thank you, John. And maybe to link with the last question in terms of because skills, you both mentioned skills shortages. We have a question from Ursuline Secondary School in Tipperary. What sectors will be the key to employment opportunities for us? I know it's a bit difficult to predict the future, but what are the sort of the evidence or trends that you're seeing?
Yeah, so
yeah, John, go ahead, please. Yeah,
I go first. Yeah, and then Michael in there. Well, obviously, when you look at the outlook and some of the things I mentioned there, the risk challenges, sustainability, green agenda, that's very much becoming more front and center of how a lot of businesses organize themselves now in a key focus. But also, that's likely to see new sectors develop. And on top of that, then technological innovation. So, manufacturing will obviously be more challenging. But in terms of services, a lot of new service type sectors, probably huge growth potential there around that on the back of, technological innovation, further developments around AI, but also then that combined with that sustainability, green agenda. And, some sectors may struggle and other sectors may benefit from that. But what we're seeing at the moment and what you tend to get in advanced economies is obviously your service sector becomes an increasing proportion and your manufacturing sector does fall back to some extent.
Yeah, and just to add quickly to that, I suppose if you look at the economy over the last, say, 30 years, I mean, the Irish economy has over that period of time relied heavily on foreign direct investment. If you looked at the nature of that foreign direct investment at the outset, it was very much in manufacturing and what you might call bog standard manufacturing. So, a company opened a plant here in Ireland and then manufactures something for exports. As we moved through the time, we continue to get that foreign direct investment, but it became much more in the areas of, say, research and development within manufacturing. It also became much more important in the services sector. And I suppose as we look forward, things like, artificial intelligence would now become the next phase in that kind of innovation, stroke technology, stroke digitalization agenda. And that is maybe where, there will be opportunities, also perhaps threats to the economy. And as John said, also in relation to the climate change and the sustainability agenda and how that is becoming a much, much more important feature of economies in not just Ireland, everywhere. And again, those areas may obviously contain threats, but also opportunities for people in the future. So we'll see what transpires. It's if any of the young students eventually will work as economists, they'll realize that forecasting the economy over 6 months is a difficult task for us, and that trying to forecast what will happen over 5, 10, 15 years is extremely difficult. But there's lots of research out there on it, and indeed the governor of the Central Bank of Ireland had a speech there recently on the long-term prospects for the Irish economy and what digitalisation and the decarbonisation might mean for the Irish economy. So if students are interested, it's worth reading to get some further information and insights into the question of what the economy will look like, if you like, over the medium term. Thank you very much. And I think we're at the end of our time. I'd like to thank Michael Crowley, Senior Economist, Bank of Ireland, and John Fahey, Senior Economist, AIB, for your time and for your presentations. As said at the beginning, the slides will be sent to registered teachers' email addresses. And also the recording of today's masterclass will be available on YouTube. Again, you'll get notification of that. And as I mentioned at the start, please don't forget our European Money Quiz, which will take place next Thursday on 21st of March for the junior cert classes. If you haven't registered yet, you can go to bpfi.ie/money quiz.